Welcome back, everyone. Today we're diving into one of the most important updates that affects every single one of us, the latest CPI inflation report, and what it means for your money, your Social Security, and the entire U.S. economy. Inflation has been creeping back up, yet the Federal Reserve is still expected to cut interest rates at its next meeting. Now, that might sound confusing. Why would they cut rates if inflation is rising? That's exactly what we're going to break down, step by step. This is not just about numbers on a chart. It's about your grocery bills, your credit card interest rates, your savings account, and even the long-term stability of Social Security. So stick with me, because by the end of this video, you'll understand not just the headlines, but also the deeper story behind these moves. And before we get started, make sure to hit the like button and subscribe to Social Security Post so you never miss an important update. The headline CPI, which measures the overall increase in consumer prices, came in at 2.9%. That's an uptick from last month's 2.7%, which shows that prices are once again climbing. On the other hand, the core CPI, which strips out the volatile categories of food and energy, remained unchanged at 3.1%. These two numbers might sound small at first glance, but they represent the pace at which your cost of living is rising month after month. For context, the Federal Reserve's official inflation target is 2%. That means both headline and core CPI are well above where they need to be. This is significant because it means the average American is still paying more for essentials, from groceries to rent to medical care. Even if the pace of inflation is slower than during the pandemic years, it's still eating away at household budgets, especially for retirees and Social Security recipients who live on fixed incomes. The Federal Reserve has been laser-focused on getting inflation back to 2%, but the reality is much harsher. Inflation bottomed out earlier this year, back in April, and since then it's been steadily rising again. That's the opposite of what the Fed was hoping for, and it suggests that their job is far from done. This creates a very delicate balancing act because fighting inflation too aggressively can weaken the economy, but ignoring it can push prices even higher. When you look at this through the lens of ordinary Americans, it means that the price relief we briefly felt earlier in the year is now fading. If prices keep creeping up, it directly impacts Social Security beneficiaries because their cost of living adjustment, COLA, is tied to inflation. Higher inflation now might mean a larger COLA in the future, but it also means higher living costs right now, and that's the trade-off everyone is feeling. Despite the rise in inflation, the Federal Reserve is still expected to cut interest rates. Why? There are two big reasons. First, the Fed believes that this acceleration in inflation is temporary. They've used the word transitory in the past to describe inflation spikes, and while many people doubt that reasoning, it's the view that guides their decisions. Second, the Fed is worried about the labor market. A weaker job market can drag the entire economy down, and they want to soften that blow with lower rates. In simple terms, the Fed is betting that inflation will cool down on its own, while the labor market needs more immediate support. By cutting rates, they make borrowing cheaper for businesses and households, which theoretically stimulates growth. But the risk here is clear. If inflation doesn't cool down, these cuts could actually make the situation worse by fueling more price increases. It's a gamble, and Americans are the ones caught in the middle. Before the CPI numbers came out, markets were almost certain that the Fed would cut rates by a quarter point. The CME FedWatch tool showed a 92% chance of a 0.25% cut and only an 8% chance of a half-point cut. That kind of certainty is rare in financial markets. It showed that Wall Street had already priced in the move and was waiting for confirmation. After the inflation report, the odds barely shifted. Now, there's an 88.8% chance of a quarter-point cut and an 11.2% chance of a half-point cut. The key takeaway here is that investors aren't rattled by the slightly higher inflation number. They still expect the Fed to ease up. For everyday Americans, this means the financial system is preparing for lower interest rates, which will ripple through everything from mortgage rates to savings accounts. Here's where things get even more interesting. There are 3 more Fed meetings scheduled for this year: September, October, and December. Current market expectations suggest that the Fed will cut rates at all 3 of these meetings. If that happens, the federal funds rate will fall from 4.5% down to 3.75% by year's end. That's a significant change in a very short time. Why does this matter to you? Aggressive rate cuts affect everything in the economy. They can push up stock prices and even cryptocurrencies, while lowering yields on savings accounts and bonds. For consumers, it means potential relief in credit card rates, personal loans, and mortgages. But it also risks reigniting inflation if the cuts come too quickly. It's a high-stakes balancing act that affects everyone from Wall Street investors to retirees on fixed incomes. One of the biggest drivers behind these expected cuts is the labor market. The most recent jobs report showed unemployment ticking higher, and then we got a bombshell revision to past data. Over the last year, the U.S. added 911,000 fewer jobs than originally reported, the largest downward revision since 2002. That means the job market isn't as strong as we thought, and it's a huge red flag for policymakers. The hardest hit sectors were leisure and hospitality, business services, and retail. Combined, these areas lost hundreds of thousands of jobs compared to earlier reports. For everyday workers, this translates into fewer opportunities and more competition for the jobs that are left. For the Federal Reserve, it means urgent action is needed to prevent a jobs crisis. That urgency is what's pushing them toward aggressive rate cuts, even with inflation above target. Just as important as consumer inflation is producer inflation, the prices businesses pay before goods ever hit the shelves. In August, the Producer Price Index, PPI, unexpectedly dropped. That means businesses are paying less for goods and services, which could eventually translate into lower consumer prices. In theory, that should take some of the pressure off households. This drop in PPI gives the Fed political and economic cover to cut rates more aggressively. If producer inflation is easing, the risk of runaway consumer inflation is lower. But remember, these trends don't always pass through directly. Sometimes businesses pocket the difference instead of lowering consumer prices. So, while this is good news on paper, the reality for families at the checkout line might look very different. The Federal Reserve is supposed to be independent, but that doesn't mean it operates in a vacuum. President Trump recently blasted Fed Chair Jerome Powell on Truth Social, saying, "No inflation, too late, must lower rates big right now." Treasury Secretary Scott Bessent echoed this, calling for a 0.5% rate cut. These statements aren't just noise. They put public pressure on the Fed to act more aggressively. For markets, this political pressure adds another layer of uncertainty. Will the Fed hold its ground and stick with smaller cuts, or will it bow to calls for bigger moves? For the average American, political fights like this might seem far removed, but they directly affect borrowing costs, investments, and even Social Security adjustments tied to inflation. The stakes couldn't be higher. Inside the Federal Reserve, there's debate too. Even the more dovish members, like Fed Governor Christopher Waller, have said they support a smaller 0.25% cut. Waller and others argue that while the labor market is softening, conditions aren't collapsing fast enough to warrant massive cuts. They'd rather take smaller steps and watch the data unfold. This cautious approach is designed to avoid falling behind the curve. If the Fed cuts too much and inflation spikes again, they'll have to reverse course and hike rates aggressively. That would send shockwaves through the economy. So, the internal debate is really about risk management, supporting growth without stoking another inflationary surge. Looking ahead, the direction is clear. Monetary policy is about to get easier. That means more rate cuts, cheaper borrowing, and potentially rising prices in everything from groceries to housing to stocks. The question is how aggressive the Fed will be and how fast they'll move. That's the uncertainty hanging over the economy right now. For Social Security recipients and retirees, this has a double-edged effect. On one hand, rate cuts can boost investments and lower borrowing costs. On the other hand, they can also fuel higher inflation, which erodes fixed incomes. It's a delicate balance, and it's why so many people are paying close attention to every Fed meeting this year. So here's the bottom line. Inflation is still running hotter than the Fed would like, but weakening job numbers are forcing them to consider multiple rate cuts before the year is over. Whether those cuts come in small steps or big moves, the impact will hit all of us through prices, savings, and benefits. What do you think? Should the Fed go big with rate cuts to protect jobs, or should they stay cautious to avoid sparking more inflation? Drop your thoughts in the comments below. I'd love to hear from you. And don't forget to like this video and subscribe to Social Security Post for more updates on Social Security, inflation, and the economy.